Welcome back to the Deep Dive. We know your time is valuable, so we dig through complex research to bring you the crucial insights you need. Today we're doing a deep dive into Walgreens Boots Alliance, ticker WBA. It's a retail giant, really at a critical point now, especially after a recent private equity takeover. We're looking at this through a value investor's lens, maybe even a distressed situation lens. As of October 12, 2025, the share price was just $11.98.
Yeah, and that $11 dates, it's practically a flashing red signal from the market, isn't it? What's really striking here, and why we're diving deep today, is this huge disconnect. Our own educational valuation model, looking at potential future cash flows if this turnaround works, it suggests WBA could, maybe, be worth somewhere between $28 to $38 per share. But the market's saying less than $12.
Wow, that's a massive gap. It is. So the big question today is, why is that risk premium so incredibly high? We need to get into the weeds on the debt, the strategy failures, and what this new plan actually involves to see if there's a path forward. Okay, sounds like a plan. So let's start with the foundations. We'll spend the first part looking at the core business, let's call it management chaos, and the financial fallout. Then in the second half, we'll shift to market sentiment, the big change in ownership, and those external risks that could still, sink the ship. All right, let's kick off with Chapter 1, Business Analysis. What does WBA actually do these days?
Fundamentally, it operates in three main buckets you should keep in mind. There's the U.S. retail pharmacy, that's the traditional Walgreens stores, the core business. Then there's international, mainly the Boots brand you see in the UK and elsewhere. And finally, the U.S. healthcare segment. This was the big strategic pivot, and as we'll see, it became a bit of a problem area.
And the money primarily comes from
Distance, right. Exactly. Roughly 2/3 of their total revenue is driven by dispensing prescription drugs. That's the engine.
Okay.
But here's where it gets interesting, what we're calling the foot traffic paradox. WBA has this huge physical footprint, right? 8,700 stores in the U.S. They claim a store is within 5 miles of, 78% of the U.S. population? Yeah. And surprisingly, they actually get more people walking in the door than CVS.
Wait, really? More foot traffic?
Yeah, their data suggests they capture about 50.4% of drugstore visits compared to 44.0% for CVS.
So more people go into Walgreens, but CVS makes way more money. How does that work? Their market share by revenue is only 16.6%, miles behind CVS's 41.5%.
It boils down to monetization. WBA just doesn't make as much money from each customer visit. CVS has that vertical integration, their own pharmacy benefit manager, Caremark, and their insurance arm, Aetna. So CVS captures value all along the chain. WBA brings people in, often for prescriptions where the pharmacy margin is already squeezed thin, sometimes even negative. While the PBMs and insurers, like CVS's own units, keep a larger slice of the pie, WBA is mostly just dispensing.
Which leads us neatly into the PBM threat, pharmacy benefit managers. We hear about them constantly. How exactly are they making life so difficult for WBA?
Well, it's fundamentally about market power. You've got three big players, CVS, Caremark, Express Scripts, and Optimarks, controlling nearly 80% of the market. It's an oligopoly. And they use that power to, squeeze pharmacies. They often reimburse pharmacies less than the actual cost of the drug they dispense.
Less than the cost. How can pharmacies survive that?
It gets worse. On top of that, months later, they hit pharmacies with these unpredictable retroactive fees called DIR fees, direct and indirect remuneration.
DIR fees. They sound nasty. Why are they so damaging?
Because they destroy predictability. Imagine you dispense a drug, you think you've made a tiny margin, maybe a few cents. Then, 6 months down the line, the PDM claws back a chunk of money based on some performance metric you might not even fully control. Suddenly, that transaction is a loss. For WBA, relying heavily on these outside PBMs means their core profit engine is constantly under pressure and highly unpredictable. It's a structural vulnerability.
Okay, that explains why they might have felt desperate to try something else, like that healthcare push.
Precisely. They were trying to find a way out of that PBM chokehold. Which brings us perfectly to Chapter 2. Management evaluation, and what a ride it's been, just sheer strategic whiplash.
3 CEOs in only 2 years. That's chaotic.
It really is. You had Rosalind Brewer, a retail expert who led the charge into healthcare. Then, when that started looking shaky, they brought in Tim Wentworth, a healthcare industry veteran, supposedly to fix the financial mess. And now, under the new private equity owners, Sycamore Partners, they've installed Mike Motz, another retail guy with a clear mandate to reverse course completely. A renewed focus on retail. It's a full retreat.
And the cost of all this back and forth.
Yeah.
It's not just strategic confusion, right?
No.
There were real financial consequences, like the opioid settlement.
Huge consequence. A massive $6.8 billion pre-tax charge just in fiscal 2023 related to the opioid crisis settlements. That's a direct hit to the bottom line.
And the healthcare acquisitions themselves. You mentioned Village MD.
Right, that was the centerpiece of the failed strategy. They poured over $6 billion cumulatively invested into Village MD primary care clinics, plus Shields Health Solutions and CareCentrix. The idea was this integrated health ecosystem. The reality, a disaster. They ended up taking a $5.8 billion non-cash goodwill impairment charge on Village MD just this year in 2024.
So basically writing off almost the entire investment.
Essentially, yes. It's the company admitting we massively overpaid and this integrated model didn't work. Now the new owners are breaking these healthcare assets up into standalone entities. It confirms the failure.
Another huge red flag for investors must have been the dividend. They were famous for increasing it, weren't they?
Absolutely. A dividend aristocrat. 43 straight years of increases. That's a serious track record. Then, boom, slashed by 48% in January 2024. And then earlier this year, suspended entirely. Gone.
They didn't just cut it, they eliminated it.
Eliminated it. That tells you everything you need to know about their cash situation. It wasn't a choice, it was a necessity. They needed to preserve every penny.
We can see this failure reflected in the core profitability metrics too, like return on invested capital, ROIC.
Oh, definitely. The ROIC has been just dreadful, deeply negative. The trailing 12 months figure is around negative 9.15%.
Negative 9%.
Yeah. And you compare that to their estimated weighted average cost of capital, or WACC, which is about 6.53%. So they're borrowing money or using equity that costs them over 6%, and then they're investing it to generate a negative 9% return. They were actively destroying value with those investments. It's textbook bad capital allocation. Ouch. Okay, let's pivot to the hard numbers in Chapter 3, Financial Analysis. The market cap tells a story down to around $10.36 billion from a peak of over $100 billion. That's just a brutal collapse, incredible value destruction. And you see it reflected everywhere in the income statement. Gross margins squeezed down to just 18.0% in fiscal 2024.
18% gross margin for a retailer that size. That's thin, very thin. And operating margin completely collapsed into negative territory, negative 9.5%. They're losing money on core operations before even considering interest and taxes. But the real alarm bell seems to be free cash flow, right?
That's the killer metric here, I think. This company used to be a cash cow, generating over $4 billion a year in free cash flow back in fiscal 20 and 21. Solid numbers. Fast forward to fiscal 2024. They didn't just generate less, they burned cash. Negative $0.4 billion in free cash flow.
From plus $4 billion to minus $0.4 billion in just a few years.
Exactly. That reversal explains everything. The healthcare retreat, the dividend suspension, the desperate need for asset sales. They ran out of cash generated by the business.
And that cash crunch must put enormous strain on the balance sheet. Talk about the debt.
Yeah, the financial fragility is stark. The debt-to-equity ratio has ballooned. It's now at a really dangerous level. 4.0, $4 of debt for every dollar of equity. Wow.
It means there's very little cushion if things go wrong. And compounding that is the short-term picture. Look at the current ratio.
Ability to pay near-term bills.
Right, it's only 0.60. That means they have only 60 cents of liquid assets for every dollar of liabilities coming due within the next year. A current ratio below 1.0 is usually a warning sign. 0.6 really sounds perilous. How are they even operating day to day?
Carefully. Lots of negotiating with suppliers, drawing on credit lines, and critically selling off assets piece by piece to generate cash infusions. It's why their debt is rated as junk. The market sees a real risk of default if this turnaround doesn't gain traction quickly.
So with all these losses, the standard price-to-earnings ratio is useless, right? It's negative 1.64 on a trailing basis.
Completely meaningless, yeah.
You mentioned a forward PE.
Right. This is where the potential bull case, however faint, emerges. If you believe the analysts' forecasts big, if that sycamore can cut costs, sell assets, and get back to some level of profitability, then the forward PE ratio is estimated around 7.47.
Okay, 7.5 times forward earnings. How does that compare?
That's significantly cheaper than competitors like CVS. So the potential is there for a value play, but it rests entirely on whether you believe those future profit forecasts are achievable given the mountain of debt and operational challenges. Okay, let's move into the second part. Chapter 4, Market Sentiment. Given everything we've discussed, I assume Wall Street analysts aren't exactly bullish. No, skeptical would be putting it mildly. The consensus rating is basically hold or even reduce. And interestingly, the average analyst price target is actually below the current trading price, somewhere around $10.59. They see more downside risk than upside potential, even at these depressed levels.
So the pros are pessimistic.
Oh,
Any glimmers of hope in the technicals, maybe?
well, just before the take-private deal was finalized, there were some small positive signs. The stock had managed to crawl slightly above its 50-day moving average, which was around $11.66, and its 200-day, around $10.81. And short interest wasn't excessively high, only about 2.61% of the float, so the market seemed to expect continued pressure, maybe, but not an imminent implosion.
But the defining event recently was the takeover.
Right. Absolutely. The finalization of the take-private deal by Sycamore Partners in August 2025 changed everything. Which leads us straight into Chapter 5, ownership structure. This is fundamental. WBA is off the public markets now. Completely different ballgame. No more quarterly earnings calls, no more pressure from public shareholders demanding immediate results. It's now a private entity delisted from NASDAQ.
And control rests solely with.
Solely with the private equity firm Sycamore Partners. They call the shots now.
What does that mean practically for the turnaround?
It means they have the breathing room, theoretically, to do the really hard, painful stuff, aggressive cost cuts, breaking up the company. They're talking about maybe 5 standalone entities, selling off major assets like Village MD. These are things that are much harder to execute under the glare of the public markets.
Okay, that makes sense. And there was a significant signal from a key insider during this process, wasn't there? Stefano Pessina.
Yes. That was fascinating. Stefano Pessina, the former executive chairman, really the architect of the original Walgreens Boots Alliance merger. He agreed to roll over his entire 17% equity stake into the new private company.
Team cash out.
Nope. He kept his skin in the game and betting alongside Sycamore. That's a pretty powerful signal of conviction, suggesting he believes Sycamore can actually pull off this turnaround and create significant value from here.
All right, let's assess the path forward in Chapter 6. Risk assessment, focusing on a sort of SWOT analysis. Strengths seem clear enough. Yeah, the vast retail network is still a huge asset, that proximity to the population. And the strong brand equity Walgreens and Boots are still household names.
Weaknesses are equally clear, unfortunately. The financial distress, massive debt, poor liquidity, and the legacy of that failed M&A strategy.
Definitely, those are the big internal hurdles.
So what are the opportunities, specifically under Sycamore's control? The opportunity is the restructuring. Aggressive cost-cutting across the board, streamlining operations that became bloated, and crucially, asset divestitures. Selling Village MD and potentially other non-core parts is job number 1. They need that cash desperately to pay down debt and simplify the business back towards that retail pharmacy core.
Okay, but the threats loom large. We keep coming back to the debt. The buyout itself piled on more leverage, right?
Yeah.
Over 70% debt financing.
That's right. It's a classic leveraged buyout playbook, but it significantly increases the financial fragility. And the biggest external threat tied to that is interest rates.
If rates stay high or go higher.
It becomes incredibly painful. Servicing that mountain of debt chews up cash flow that could be used for operations or further investment. And perhaps even more worrying is the refinancing risk. When large chunks of this debt come due in the next few years, if they have to refinance at much higher rates, the interest burden alone could become unsustainable. It's a major sword of Damocles hanging over them.
And you mentioned another specific, more recent threat, tariffs.
Yeah, that's a nasty curveball. The U.S. imposed tariffs of 2025 on imported goods, including pharmaceuticals and general merchandise that Walgreens sells. With gross margins already razor-thin at 18%, adding tariffs just squeezes them further. They either have to eat the cost, crushing margins, or pass it on to consumers and risk losing sales. Neither option is good. Okay, so let's bring it all together in Chapter 7. Conclusion. How do we synthesize this? What's the bull case, if one exists? The bull case is essentially an asset play plus execution bet. You look at the tangible value of the real estate under those ACE of 700 stores, the brand names. You combine that with the hope that Sycamore Partners, known for ruthless cost-cutting, can successfully execute this painful restructuring. Shed the unprofitable healthcare bits, use the cash to slash the debt, and emerge with a leaner, potentially profitable retail pharmacy core. If they pull that off, maybe, just maybe, you could justify that $28 to $38 intrinsic value range we talked about at the start.
Okay, that's the optimistic view. What's the bear case?
The bear case is stark and immediate. A crushing debt load, junk rated, in a potentially rising rate environment. That's existential risk number 1. Number 2 is the unresolved structural PBM threat. Even if they fix the internal issues, the PBMs are still there, squeezing margins on their core prescription business. And number 3 is history. Private equity turnarounds in retail are notoriously difficult, often ending badly. Sycamore itself has a mixed record over the front. Think about companies like Belk that struggled under their ownership. Bankruptcy isn't off the table here.
So it really comes back to that valuation paradox.
Exactly. The current share price, or well, the implied price pre-delisting, around $11.98, versus a potential intrinsic value maybe 3 times higher. That gap is the market pricing in the enormous execution risk, the leverage risk, and the industry risk.
What's the final thought for our listeners to chew on? I think the provocative thought is this. Forget the legacy, forget the number of stores for a moment. The future value of Walgreens Boots Alliance won't be determined by its past glory or its physical footprint. It hinges, almost entirely, on one single thing. Can this new management team under Sycamore successfully execute an incredibly difficult, radical turnaround while simultaneously managing a crushing debt load in an industry that is itself structurally flawed and hyper-competitive?
That is the multi-billion-dollar question, and frankly, the outcome is completely up in the air right now.
A truly high-stakes battle. Thanks for breaking down such a complex and, frankly, perilous situation for us. Really highlights the risks and potential, however slim, in distressed investing.
My pleasure. It's a fascinating case study, that's for sure.
And thank you, our listener, for joining us on this deep dive. We hope untangling this helps you process the situation.
And hey, if you find these deep dives valuable, please like and subscribe to Stock Analytics AI. For €4.99 a month, members get priority access to our deep dives. We're planning to cover all the S&P 500 stocks over the next few months, and members get first dibs.
Or if you just want a specific company covered, drop us a super thanks on the video, and we'll see what we can do. And finally, the important bit.
This analysis was generated by an AI system.
It's for educational purposes only and should definitely not be considered financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.